Hey all, this is a follow-up video to the introduction to adjusting entries. And what I'd like to do is I would like to explain prepaid expenses a little bit more, how they start as an asset and then they move into an expense for the business. So let's get right into it. And I'm going to start with an example that is not an adjusting entry. So to use this, I've obviously blown myself up a bit and I will minimize the screen as I show journals, but we're going to use Monopoly money. And let's assume, so you have to trust me here, I have 12 $100 bills here. So there are 12 $100 bills, indicating that each month, let's do insurance. Insurance costs us $100. So every month I'm going to pay $100 in insurance. So in an accounting system where I'm paying my rent or my uh, insurance or another prepaid, what could be a prepaid expense at the time, then it's just a regular expense. So if I were to do that, I'm going to head over to a journal right now and show you the non-adjusting entry. This is what it would be. Let's say I pay insurance at the beginning of the month. So on January 1st, I would have an insurance expense, and it's $100 is what we said, and I'd pay $100 cash for it. Right, so insurance for January. And then February 1st, I would once again have this. So I would repeat this 12 times. Each month, I am paying $100, right? So that is if we aren't using adjusting entries. So I think that's pretty easy to understand, but it's also not the purpose of this unit. So let's put that aside now. That is a regular transaction that we saw in previous units. Now let's get into prepaids and how they work. So I'm going to keep that January 1st up, just so that we can see. And you know what? I'll leave February 1st up too. So let's do this. See if I can blow myself up here. Can I do that? I'm sure I can. Okay. So let's get into now how prepaids work. So in a prepaid relationship, what we're going to do is we are going to take that entire amount that we are going to pay in insurance for the year. In this case, it's $100 a month times 12 months, and that's $1,200. So all of this cash, this wonderful Monopoly cash here, that's my entire year's worth of insurance that I'm going to spend. So if I were to count it out, I have $1,200 here. So in a prepaid relationship, this is what we do. We're going to pay all of this up front on January the 1st. So this is not an adjusting entry that I'm going to show you. This is an opening entry that I'm going to do for this. So on January the 1st, what I'm going to do is I am going to have prepaid insurance for $1,200, and then cash for $1,200. What you'll see is my insurance still costs the same. I'm just paying it all in advance. Now, if I were to do a T account for this, maybe I'll set up a quick T account here as well, just so that we can see it. So this might be a good visual for you. So let's just go ahead and do this. And by the way, this is actually not a bad, what you're watching right now, this is not a bad thing for you to do either as you're trying to get your understanding of this. This will kind of help you out a bit. So we have prepaid insurance. And then I'll add a few accounts as we go so that we can see. And let's do cash as well. So I have $1,200. For some reason, everything's bolded here, so I'll just take the bolds out. $1,200 in prepaid insurance, and I paid $1,200 in cash. Now let's go through each month. So end of the month happens. How much insurance have I used? I've used 1/12 of my insurance. So that now is an expense to the business. And I have to claim it as an expense to the business because that insurance represents the time period that I earned revenue. And so I paid 1/12 of my insurance, and I've used 1/12 of my insurance in the month of January. So my adjusting entry will look as follows. It is now an official expense to the business for $100, and I don't pay cash because I already did it. I have 100 less in my prepaid insurance, so that's $100. So if I were to do a T account here, I would credit this, and now my balance is $1,100, which represents 11 months of insurance. A month from now, I am going to do this once again. So insurance for the month, etc., etc. So this now becomes my adjusting entry every single month from now on. On December the 31st, I have no insurance left. Just like in my first example, when I paid $100 each month, I didn't have any more insurance to pay. In this case, by the end of the year, I don't have any insurance to pay. Now, there are benefits to doing this. Sometimes you'll get a bit of a discount or something, so it makes sense to pay it up front because it costs you less overall. So there are different reasons why companies will do this. But to finish off this example here, we did have an insurance expense. So what we do is we actually have an insurance expense of $100, and this was our adjusting entry right here. And it's represented right here and here and so on. So as I go through the months, so if I do March, I will have another $100. So now my insurance expense for the year is $200. And then I have $1,000 or 10 months of insurance left and so on. So what will happen is this is going to go down by $100 each month to the point where it's zero on December the 31st. Our insurance expense will go up by $100 each month to the point where it is worth $1,200. And that is the purpose of our adjusting entries, whether it's supplies or insurance or rent. We could have bought supplies for $1,200, and then at the end of the month we notice we have say $1,000 of supplies left. Then we would have a supplies expense for that month of $200, and it would be not prepaid supplies, it would be supplies for $200. So all we're doing is we're updating our account at the end of the month. How much is left? And remember, why is prepaid insurance an asset when it's on the debit side or when we purchase it? It's because if I were to sell my business tomorrow to you, and you would say, so what comes with the business? I would say, okay, the business has $10,000 in cash. We have $1,000 in receivables. We have $4,000 in supplies. And I also paid insurance at the start of the year. And you're buying this business at the start of the year, so there's still $1,200 worth of insurance that I paid, and the buyer of the business would say, okay, that's worth $1,200, so I will give you that. But once I use it up, once it becomes an expense, it's no longer an asset or an item of value to the business. So on February the 1st, if someone bought the business, I would say, I have $1,100 worth of insurance left, and they would pay me $1,100. So that's the process. I want to tell you one last trick, and I can't remember if I did this in the last video, but the really nice thing about doing adjusting entries, and it doesn't matter which one it is, 100% of the time it's going to be whichever item it is, and then the word expense, because it becomes an expense, and then it's going to be the name of the asset every single time. So it's expense, debit, credit the asset. So it is insurance expense, and the asset is prepaid insurance. Or it's supplies expense. It's not prepaid supplies, it is supplies. Or it is rent expense, prepaid rent. Those are the three that we're studying right now. We're going to include something called depreciation shortly in our next note, but I just wanted to clarify this for everyone. So I hope that helps clear a few things up for you as you're doing these and the reason why we do them. In summary, let's get out the monopoly money again. If we don't do adjusting entries, we pay every month. And we pay every month this much. And the entry would be rent expense and cash. That's it. It's not an adjustment. If we are using prepaids, what we do is we pay it all up front. So the cash comes out up front for the full amount, $1,200. Every month at the end of the month, we have insurance expense, and then we have $100 less in prepaid insurance, so we credit it. So that's your tutorial. Reach out if you have any questions. See ya.